Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. This week's video is going to focus on the SP 500. I'll cover the ASX 200 and commodities in a separate video, and I'll leave a link to those in the description section below. I've also got some fascinating graphs for you, so make sure you stick around for those. As always, this is general commentary and doesn't take your personal situation into account. All right, well, let's jump to our first chart. So here we go. We've got the SP 500 on the screen, and it's been a relatively quiet week following some big days in the over the last recent weeks. And we're really waiting now to see which way the next big shift in momentum is going to be. So there are a couple of possibilities at play that I want to go through today. So the first one is that the market is now stabilizing, and everyone who wants to sell has now sold, and that potentially sets the market up for some sort of a corrective rebound to the upside. And there's just so much negative sentiment out there at the moment that it does potentially set the stage for a meaningful rally, where it's possible we do see the market punch higher up into the low 4,000s. So that's one of the potentials over the next few weeks. And I'll just give you a quick look at this graph I saw through the week. Gives you an idea of how bad sentiment actually is at the moment. So this is from a group called Bespoke. It's a really interesting graph. So what they've done, they've calculated the number of consecutive weeks that bullish sentiment from the American Association of Individual Investors has been below 25%. And so here we are now. Now there's been 5 weeks in a row where bullish sentiment from this survey has been below 25%. Now you have to go back 29 years to 1993 to find a similar period, a similar 5-week stretch where sentiment has been so bad. So it really does give you an idea of how extreme current situation is. And the other possibility that could be taking shape is that what's happening through here is the S&P 500 is potentially just establishing a new ledge from which to fall off. And that sort of scenario still remains on the table. There's nothing in this price action to rule out that we have another sharp decline in the making, that another sharp decline is coming over the next few weeks. So I want to start first by looking at the bullish case, looking at the bullish scenario which could be forming in the market. Because what we have a potential bullish wedge formation which has been developing since the February low. Draw that in. It's not perfect in that it does dip below the framework of the pattern, but that can happen, and we still do have that general wedging shape coming through here. And as the wedge narrows, the price action has been narrowing as well. And where we find ourselves now is we look at this. It's interesting to look at this June low. It's possible that this was a failed break lower. So we've got the low here in May, broke below, like a natural place to have stop losses and to initiate new short positions and to reaffirm someone's bearish view is a break of a previous low. So we had the break of the previous low here in June. Market initially declined and then snapped back. So it's possible we could call this a failed break. And if that were the case, well, then you'd say, well, look, maybe this was an exhaustion low. It was a final fling lower. All those who wanted to sell sold, and now the market is poising itself to try and punch higher. And it's interesting when we throw on an advanced decline line. You might remember I looked at this last week. And because what we have on the advanced decline line is some divergence. So when the market made a new low in June, the advanced decline line didn't confirm with its own new low. What we'd like to see now, if the bullish if the more bullish scenario were to take place, and this is not necessarily calling a final low by any stretch, it's looking for a short to interim low, then have to assess the price action as it develops. But what we'd want to see is that the advanced decline line then next moves above this point here from late June, and then this point here from early June. If it does that, well, that does give some substance to the possibility that this is a bullish wedge, and we do get a break to the top side. And then that breaks the sell cycle, which has been in place for several months, and it breaks that sequence of lower lows and lower highs and gives the potential for higher levels, and then we can reassess how that price action develops as to how much further we think that could possibly go. And so that is one of the possibilities which is out there. So what's needed? What needs to happen to activate that scenario? And to do that, I want to jump over to a 4-hourly chart to see what do we need to look for to see whether this is going to whether this could play out. So over to the 4-hourly chart. What I want to do here, I want to focus in on this last leg of the decline. And I'm going to put on some Fibonacci retracements. Just draw those in. And so what we have when we look at the Fibonacci retracements is we had the rally off the June low, came right up into this Fibonacci region, just above the 50%. Then it started to back off. The Fibonacci region rejected the rally, and the markets pulled off. It's now coming back, and it's now retesting that area. Now, I think the key to this whole potential upward leg scenario, upward momentum scenario, is around this 4,000 mark. So if we just look at around this 4,000 mark through here, we've got the top of the Fibonacci band, we've got the upper band of the wedge pattern, and we've also got the high point from June. So it's all coinciding around this region, which is just below 4,000. So that's why I say 4,000 is a key level. If the market can work its way above these points here, then it opens the possibility of short covering for momentum to build upon itself and to have potentially a notable rally and break that sell cycle. And if I go back to the daily chart for a moment, and I just put the moving averages on, and you see when we do that, there's a 50-day moving average coming through here. 50-day moving average is also around that 4,000 mark. So you could say that 4,000 region, it really is a technically active area. So it's one which I think we want to watch closely. And if the market can break above there, it does set the stage for some more positive price action, more positive scenarios. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, Jason, thanks for the video. Just something really short because it tells YouTube that you're engaging with the video, that you're interested, and then YouTube will be more inclined to show other people. And that helps me so much because I get to get my message out there to more people and build my YouTube channel, build my presence. Also, please hit that subscribe button and help me grow my subscriber numbers. So if you could do those things, that helps me so much. And because it does take a lot of work to put these videos together for you. So that little bit you could do for me would be much appreciated. So, all right. So what could go wrong? So that was looking at a potential bullish, it's not necessarily bullish, but it's just breaking that bearish cycle. We can't get bullish for a while yet. We need a lot more price action to happen. But what could go wrong with that potentially positive scenario? And well, the thing to note is that sometimes wedges don't break to the upside. Sometimes they fall out the bottom and they accelerate lower. Price action like this is what you'll sometimes see happen. You get a wedging looking formation, you're thinking this is looking okay, and then it accelerates to the downside. I've seen that happen, quite a bit over the years, and it does occur. And so that would fit in with that cascading scenario which I've been speaking about over the last couple of weeks. If you've been watching, I've been talking about this cascading setup on the chart. And the cascading setup is where the rallies get shorter and the declines get sharper. And we're at that point now where if we will get that sharp, really sharp capitulation sell-off, this would be the natural place for it to occur from. So that's what we need to be aware of. You know, that risk is still on the table, and look, it's something to be aware could happen. So I'm going to give you some levels to help understand if that were to start to engage. So to do that, let's look at the 4-hourly chart and go, okay, where does that unpleasant scenario engage? And to do that, let's just look at this rally off the low, and let's put the Fibonacci's on that. So you can see when we had that rally back, then we had the rejection of the Fibonacci region of that decline, rejection of that, market came down, came back to around the 61.8%, and now it's rallying again. So what happens? Now, I think if the market can't get above this 4,000 area, we've got those resistance points going on. If it doesn't get above there, instead if it rejects there and reverses down, we start to break below that Fibonacci region. It's right around here, right around 3,700, that I think we're on red alert. We're on red alert for this to give way to an accelerated decline. Unpleasant possibility, but you know, it's very much out there. And I've got to tell you, really, I'm finding this a very difficult market to call right here. I think both scenarios have merit, and I wouldn't be surprised either way, whether we get an up market over the next couple of weeks or like we get a sharp sell-off. And I had a guy leave a comment a couple of weeks back, and he sarcastically said, look, this is brilliant. You've identified the market could go up or it could go down. And look, in one respect, he's right, because that is what I do tend to say most weeks. I give possibilities, and I do that because I don't know. I don't know where the market's going to go. Nobody does. And if anyone tells you they do know where the market's going to go, well, they're really not being serious, and they're not being fair to you, and they're giving you misguided hope into whatever they're saying. My job is to identify possibilities and then to help you understand the likelihood of them playing out. And while I don't have a crystal ball, hopefully I can provide you with a framework that at least helps you navigate what are highly uncertain markets. And I've got one more graph just before I go. I've got one more graph for you. It turned up in my Twitter feed during the week. It's a fascinating graph. So the top half shows the SP 500 and goes back to 1962. And the bottom half, this is the fascinating part, the bottom half down here, so I'll explain what it's doing. What this is doing, it's showing the number of times the S&P 500 fell at least 2% during the day over a 50-day period. So if we look at the current 50-day period, there are 15 days where the market fell at least 2%. And that's only happened 12 other times in the last 60 years. And the average, and this is really interesting, these guys over at Sentiment Trader, they've worked out that the average market performance over the next 12 months has been 21.5%. So I think that's a positive sort of potential backdrop to keep in mind. But look, one thing to be cautious of with these averages is I can see at least 2 points. This one here around 1974, where the extreme was just a midpoint in a larger decline. And the same here in 2001, the extreme was a midpoint. So just got to be careful with those averages because they're useful, but situations can get even more extreme. So with so much bearish sentiment out there, look, it can be tempting to try and pick a low point. I'm hearing people are trying to do that at the moment. They're saying, look, there's so much negativity, things have got to go up, they can't get any worse. But I think our base case I think our base case has to be that while the market remains below these moving averages, while the market remains below the moving averages, below the 50, the 100-day moving averages, whilst we're below there, that broader trend is still lower. We've got to respect that. We've got to respect the risk that this market deteriorates further. So I think the name of the game remains defense, not taking undue risk, not trying to call the lows. We've got to let the price action tell us when the time is right to really get positive about the market. But there are some interesting things to keep an eye on over the next couple of weeks. So those levels. We're watching 4,000, we're watching 3,700, and we'll see what the market brings us. Hope that was helpful. Please give me a like. Look forward to talking to you next week. Until then, bye for now.